Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at DataVault AI.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. DataVault AI is, well, it's a fascinating case. It really feels like this perfect storm of hypergrowth potential and some very real, very imminent risks.
Especially in the microcap AI space, right? It's the ultimate high wire act.
Exactly. So let's start with the growth story because the numbers are, frankly, staggering.
They really are. The first thing that jumps out is that Q2 2025 revenue. We're talking $1.7 million.
Which on its own doesn't sound like a world-changing number.
No, but you have to compare it. You look back at the same quarter in 2024 and they brought in, what, $0.3 million?
That's it. So you're looking at a roughly 467% year-over-year surge. That isn't just growth, that's an explosion. It shows their tech is getting traction and they're actually monetizing it.
And management is definitely not shy about their own projections. They're leaning right into it.
Oh, not at all. The guidance for fiscal year 2025 is set between $30 and $50 million.
And for 2026, they're already floating numbers over $200 million.
It's a vertical curve. I mean, they're projecting an almost 50-fold increase in just about 18 months.
Okay, but in an AI sector, this crowded growth alone isn't enough. What's their moat? What are they doing that separates them from, the big players or even other specialized firms?
It really comes down to their specific tech platforms. They have this suite of AI-driven tools. There's Verify You, which is all about security and credentialing.
Right.
Then there's ADIO for engagement and analytics. And then you have the really unique one, the Dream Bull Draft meme coin.
That's the one that always raises eyebrows. A meme coin. How does that fit in with a serious enterprise data strategy? It seems like it could, hurt their credibility.
It does seem counterintuitive, I agree.
Yeah.
But I think the play here isn't about the meme coin itself. It's about demonstrating their capability.
A proof of concept.
Exactly. A very high-profile one. They're showing major sports leagues or brands how they can capture and analyze complex experiential data and do it fast. Then they can turn around and sell the enterprise versions, Verify You and ADIO, to those big corporate clients.
So the moat is really the AI backbone that supports all three platforms.
Precisely. And they're not just staying domestic, they're expanding globally, which, massively increases their total addressable market.
That alliance with Max International seems key, the one for the Swiss digital RWA exchange.
It's a critical piece of the puzzle. For anyone who isn't familiar, RWA means real-world assets. We're talking about tokenizing things like real estate, art.
Making tangible assets tradable on a blockchain.
Yes. And this partnership puts DataVault AI right at the forefront of what could be a trillion-dollar market. It really reinforces those competitive barriers they're trying to build.
Okay, so this all sounds incredibly promising. Hypergrowth, a unique tech moat, huge new markets. But you can't have a growth curve that steep without talking about the cost.
And this is where we get to the other side of the coin, the balance sheet.
Scaling this fast is just unbelievably expensive. The numbers make it clear they are nowhere near profitability.
Nowhere near is putting it mildly. The operational losses are substantial. They posted a net loss of around $37 million on just $2.674 million in revenue.
Wow, so that's a negative pre-tax profit margin of over 800%.
To put that in simpler terms,
Yep.
For every single dollar they bring in, they're spending more than $8 to get it and to fund that future growth. That is just not sustainable without a lot of outside cash.
And you see that cash burn creating immediate problems on the balance sheet, right?
Yeah.
Looking at the numbers from November 2025.
Yeah, their current ratio is just 0.5.
Right.
And the quick ratio, which is even stricter, is down at 0.1.
So in plain English, that means they have only 50 cents in liquid assets for every dollar of short-term debt they owe.
They're running on fumes. It makes them critically dependent on getting a significant injection of capital and getting it very soon.
Which brings us to the biggest catalyst and also the biggest risk hanging over the company right now.
The $150 million strategic investment from Silex Holdings.
It's everything. That cash is the lifeline.
If that deal closes, it fixes the solvency issue overnight and gives them the rocket fuel for those 2026 revenue goals.
But, and this is a huge but, the deal isn't done yet.
No, it's still contingent on shareholder approval. So its closure is the absolute make-or-break event for this stock over the next few months.
Which explains the wild volatility we've seen. I mean, the stock jumped nearly 19% just the other day, but not long ago it fell from over $3.50.
Of course, the market is just reacting to any scrap of news that changes the odds of that Silex deal going through.
But under all that noise, some of the technicals are starting to look a bit better.
They are, and that's an interesting development. If you look at the momentum indicators, specifically the 3-month mass CD, it actually just flipped to a buy signal.
That's a big psychological shift. It suggests that despite the risks, some speculative money is starting to pile in, and we're seeing that confirmed in the trading volumes.
And it's not just the charts. The sell-side analysts are echoing that sentiment.
The professional consensus is surprisingly bullish given the balance sheet.
It is. Multiple analysts have it as a strong buy. We're seeing price targets that start around $3, which is, what, about 64% upside from here?
And they go all the way up to a high of $7.
That's a huge range. And it really puts the focus on the immediate future. The next 90 days are going to be absolutely pivotal.
It all kicks off on November 17th with the Q3 earnings release and the investor call. That's test number 1.
And on that call, the market is going to want specifics. It's not just about the top-line growth anymore.
No, they'll be digging into technology adoption rates, customer wins,
And any sign of recurring revenue. They have to show that this growth is sticky and that they have a credible plan to get that cash burn under control.
After the earnings call, the next big thing is still that Silex deal. We need to see it close. But what else is on the horizon?
We need to be watching for any news flow on the Swiss digital RWA exchange. An official launch would be a massive validator for their strategy.
And we should probably keep an eye on institutional moves, too.
Definitely. You have ETF rebalancing in December, which could drive some buying. Then in January, the 13F filings come out, and we'll see if the big funds started building positions.
And of course, you can't ignore the speculative side of things. There's been a lot of chatter.
A lot. The main rumor is a potential partnership with a major sports franchise, which would be a huge client win.
There are also some unconfirmed reports about them being in talks with a private AI firm about a strategic acquisition.
Now, you have to treat those as pure speculation for now. But for a stock this volatile, any confirmation of news like that could trigger an absolutely explosive move.
So let's bring it all back to you, the investor. The next 3 months are truly the defining period for DataVault AI. For a short-term trader, it's a very compelling setup.
It is. You're essentially betting on that Silex deal closing and a strong Q3 report, which could easily push the stock towards that $3 price target.
But if you're a long-term investor, you have to weigh that massive potential in digital data monetization against the very real risk of their capital dependency and that extreme cash burn.
The question you really have to ask yourself is this. The analysts think the stock is worth somewhere between $3 and $7. What has to happen for it to reach that $7 mark?
It's not just one thing, it's a combination. The Silex deal has to close, and the Q3 earnings need to show a path to profitability, and they have to successfully launch the Swiss exchange. If all three of those things happen, $7 suddenly looks feasible. But if even one fails, the whole thesis is at risk. Your job now is to watch for those 3 signals.